500 megawatts of data centres. This is enough electricity to power a city the size of Canberra, and Goodman Group is building it right now. My name is Anna Milne, and I'm a Deputy Portfolio Manager at Wilson Asset Management. At Wilson Asset Management, we look at the world through three lenses: macroeconomics, fundamentals, and positioning. Global uncertainty is high. The economy is holding up, but it's fragile. Tariffs haven't yet flowed through to profit margins or inflation, but they have to, and they will. It feels like we are constantly one data point away from an economic shock. Fundamentally, Australia's August reporting season was underwhelming. Companies are growing profits, but often through cost cutting, and this is not sustainable. And lastly, positioning. The market is at all-time highs, and central banks are under pressure to cut rates even further, even if the data doesn't justify it. There are 6 rate cuts priced into the US curve, and what happens if these don't eventuate? Put together, none of these indicators suggest that we should be bullish on markets. But you could have said the same thing 4 months ago and missed a 20% rally in the ASX 200. So how do you stay invested, yet protect against fragility? One way is megatrends. If the market keeps rallying, momentum will keep these names going. But if the market falls, they may be sheltered. Whether we like it or not, AI is real and it is here to stay. It's likely the most transformative force of our lifetime. So if you can block out the noise and find exposures not priced like a bubble, this has to be the most compelling opportunity of our time. There'll be winners and losers, and technology is moving so quickly, it's hard to know which stocks to back. One way to play it is AI infrastructure. And there's only one large global listed stock in the ASX 200 with this exposure: Goodman Group. This is a foundational year for Goodman Group. They've completed a $4 billion equity raise and are now well funded to build out their global data centre pipeline. They have the land, they have the power, they have the partnerships, and they have the customers. And it's not without risk. But when you combine this tailwind with a team that's done it before and is extremely incentivized alongside their shareholders, it's a compelling opportunity. In the words of Greg Goodman recently, we roll up our sleeves, we don't go on holiday, and we get it done. So this is how they do it. They already own the land. So firstly, they secure power, and then they see a land value uplift. They then bring on partners and book profits on sell down to these partners. They book development fees as they build. They sign leases with the likes of Amazon and Google, who are existing customers. They complete the build, and then they book profits again as they sell down either into another vehicle or bring on debt. And then they earn recurring management fees into perpetuity. And with this capital, they then repeat the process again and again. We don't know where CPI will land, and we don't have any huge conviction around jobs data going forward. But here's what I do have conviction in. It's that by next June, Goodman Group will have 500 megawatts of data centres under development with a $10 billion end value. They'll have made progress on their global partnerships and on their 5 gigawatt power bank, which has an associated value of over $100 billion. And the best thing yet, it's trading at the lowest premium to the market that it has in 5 years. It's trading at the same premium it did when it was simply an industrial shed company. In a world where it's hard to sleep at night because of the volatility that we're experiencing, this is a stock that you can. Because regardless of what happens, we know the future will run on data. And with Goodman Group, you can own a slice of it. Thank you for your time.
Before I go into my stock pitch, I think it's been a bit of a flavour around this already this morning from what I understand, but I wanted to hit 3 key points on mid-caps and why I think it's just such a cracking part of the market. Well, firstly, look at the sector diversification you can get here, and the concentration is not in banks. Only 2% of mid-caps are in banks versus 25% for the broader market. There's plenty of opportunity. The second part I want to stress is the growth in mid-caps. Based on consensus estimates for the next 3 years, mid-cap earnings growth is expected to be double that of the ASX 200. And thirdly, it's a resilient universe. Look at the performance over the last 5 years. We've dealt with everything, tariffs, conflict, rising interest rates, but mid-caps have outperformed by 25%. A pretty remarkable effort, I would say. So flicking over to the stock pitch, it's outlined here. The stock I'm pitching is in black. It has outperformed predominantly over the last 3 years. I'm happy to take any early guesses of what it could be. It'd be a bit awkward if you got it straight away, I would say, though. It must be a market darling, but it's not covered by any bulge bracket sell-side analyst, but still sits within the mid-caps. It's probably a fintech, you might be thinking, a tech company. It's not. It's actually paid dividends for over a century. So well and truly given it away, it is indeed Soul Patts. So why do we like Soul Patts? But to understand Soul Patts, we have to understand why did it fly under the radar? Well, it flew under the radar because largely its portfolio was easily replicated by listed or by fund managers. 70% of its NAV or its distributions came from 3 listed stocks. You can see Brickworks, New Hope and TPG. So the conventional thinking was, why do I need to buy Souls when I can buy and sell these names myself? So that was largely why it really sort of sat in no man's land for a little bit. But 2 key things have happened and it's transforming the business enormously. The first factor is the acquisition of Milne. This occurred in around 2021-22 and it broadened their exposure into listed equities. But it came with one strategic benefit, and that was that under the transaction, $1 billion in goodwill was created. But due to the accounting rules and regulations, and I think it's AASB 136 to be specific, that goodwill was impaired, which meant now Soul Patts had the capability to offset future capital gains against these losses. So it actually resulted in Souls being able to recycle capital at a faster rate. The other key factor or key transaction that's currently underway and should be voted on tomorrow is the acquisition of Brickworks and collapsing the cross-shareholding structure. This is turning Souls into a $14 billion investment house with assets evenly split across both listed and unlisted investments. It's starting to look a little bit like a Berkshire Hathaway or a Blackstone or maybe even an Apollo Group. So what makes Souls so unique? Well, really it is, and its key differentiating factor is that its capital is its own. There is no third-party capital, so there's no redemption risk, there's no pressure on fees. They can take advantage of market opportunities whenever they see fit, and investing across asset classes, across the capital stack, also enables them to produce uncorrelated returns with a very low beta. So what's this actually produced over time? Well, it's an unenviable track record of distribution growth, 25 years of uninterrupted growth, 9.6% CAGR. But what I find most impressive about this chart is the fact that it's grown its quickest during periods of crisis. So if you look at the global financial crisis, the growth rate accelerated to 11.5% per annum. Through COVID, it was at 10.7% per annum. It really speaks to their ability to allocate capital appropriately. Apologies for the dry throat. So turning to valuation quickly, it trades on a NAV basis, so it's very much a balance sheet type view through the lens we view valuation. And what we can see here, based on our pro forma estimates, we believe it's currently trading below its long run average, that of a 10% premium to NAV. But looking forward, with the simplified corporate structure, a greater playground of investments, and also improved liquidity, we think that premium can expand. So applying a 25% premium to our go-forward NAV, we think Souls can move well into the $50 range. So just summing up, why is Souls a buy? Well, firstly, it's a unique business. It can invest through the cycle and there is nothing else like it in the ASX. Secondly, it has an enlarged playground with Brickworks and a simplified structure. The collapse of the cross-shareholding will improve liquidity and we should see a nice index uplift. And lastly, we see valuation premiums expanding. I'm going to leave it there and thank you very much for having me. Thank you.
Well, it's great to be here. Now, I want to tell you, at 10Cap, we just had our first annual reporting season. We love it. Why? Because we can long and short companies. We can betting our share price fall and betting our share price rise. We can also invest in emerging companies, small cap, mid cap. And in fact, we actually own some of the highest returning stock in our portfolio this reporting season. We enjoyed it. But what I really love about this reporting season, however, it's the opportunities. We're seeing so many of them. Now today, I'm going to talk to one of those opportunities. Now, I know you're going to say, I know, you're going to spruik some spicy hot stock that you always talk about. No, today I'm going to say something different. Now I'm going to give you 3 clues, okay? See if you can get it. So the first clue, this brand that you have seen in 10 countries around the world, delivering over 1 million meals a day. Clue number 2, share price has tanked. It's gone down over 60% in the last 12 months. It's not growing anymore. Everyone's heading for exit. Now the last one, this one going to be a bit obvious. Margins collapsed. Used to make so much, we used to make 8% margin, now make 5%. The company has moved from a store rollout obsession into a margin obsession. So what company is it? Oh my God, the last one was very obvious, isn't it? Domino's. Now, I do want to bring some pizza today, but unfortunately we couldn't bring it in. So, look, today I just want to tell you what is everyone missing? What is everyone missing? And what is this margin recovery that everyone's not thinking about? And I'm telling you, this is why I'm buying. No, but I get it. It's terrifying. If you look at the news flow out there, CEO exits. We've got store closure in Japan. France is not working out. Margin contraction. Analysts are downgrading. And, and then the market, the crowd, everyone else is telling you, just avoid the mess. Now, I tell you, this is when you have the best chef come into the kitchen. Share price is already pricing in the worst outcome. And the margin recovery hasn't even started its story yet. Now, Domino's is not trying to pitch to be a super ultra high growth company. We've got those high growth companies in the market, but it's not pitching to be that. It certainly is not pitching to be a great tech company where it used to be. What it is pitching at, profitability. It's trying to make more money. It's trying to make more EPS per slice of pizza, not about selling more pizza. So the Domino, as I touched on before, used to make a margin of closer to 8%, the operating margin. And just in the mere 4 or 5 years, it's gone down to 5%. Now that's a big change. The company has now identified what they need to do, and that's exactly what they need to do, is to close the unprofitable stores, stop on this rampage of store rollout. If they don't make money, close them down, and simplify the system, and focus on franchisee unit economics. Franchisee make more money, then they will roll out more stores, and that's great for you. And even if the margin just recover a tiny bit from 5%, you're looking at earnings doubling. Meaningful upside. Valuation, I think in the previous presentations, people talk about valuation and the like. It's cheap. It's on 12 times. I don't know, I think earlier on there's a panel talk about Australian companies are so expensive and the like. Well, there are cheap companies, it's 12 times. Now, people always say, oh, maybe that's what it should be and the like. But just compared to its peers, Collins Food. I love KFC as well, but Collins Food, this is 50% discount to Collins Food. Now, in my opinion, around the world, Domino has a better franchise than the KFC, even though, I do like the chicken being Chinese and all. So, look, it's a huge discount. And company just need to do what they need to focus on. Where do you take the costs out? Now, moving margins sounds like just numbers. Where does it come from? This company spends billions of dollars on costs. Their overhead doubles every other franchise business here in Australia. Why is that? Why should it be? It shouldn't. This number, $100 million being spent on IT, on some procurement and the like, that is a big number for not a tech company. You just need to take out a little bit of it. Of course, you'll reinvest part of it into your franchise, to help them to be more profitable, and then they will roll out more stores, and then they will deliver more, better store growth. And but most of it will come to your profit, come to the shareholders. So there's a lot more room to move. Jack is back. The chair of Domino, Jack Cowan, decades of experience in this space, in the fast food industry. He's demonstrated for year in, year out that he can do this. And he's telling you, he's pressing the accelerator in that cost-led EPS growth. We all know how quickly that can re-rate a company. Just look at Collins Foods. Sorry, it's comparable. I keep referring to it. Collins Foods went up 40% just in the last 3 months. This one may be the next. So, Tailwind, it's cheap. It's got a lot of opportunity in terms of the cost. And smarter pricing, lower overhead, and just more profit, more EPS per slice. So when markets smell what it's cooking, you'll be glad you heard it here first. Thank you very much.
I run the Regal Global Small Companies Fund, and I'm going to be pitching today a stock that's in that portfolio. But firstly, I just wanted to touch on a key tenet of our investment process. Now, our investment process is grounded in empirical research, and this breaks down the drivers of stock price returns over different periods of time. And as you can see, you can break it down between the change in the PE multiple in blue, or the valuation, and earnings growth in orange. And what this shows is that earnings growth is the key driver of stock price returns over the medium to long term. So what do we do at Regal? We seek to invest in companies where we can underwrite the ability to grow at really attractive, high organic growth rates over the near, medium, and long term. And identifying powerful structural growth trends is a key part of this process. It just makes it easier to underwrite the growth trend. So what's an example of one of the most dominant structural growth trends? It's the unstoppable rise of e-commerce. Here you can see US e-commerce sales as a percentage of total retail sales. It's your classic bottom left to top right chart. It's currently at 16%, but globally we're at 23%, because in China, the global leader in e-commerce, they're already at 45 to 50%. So you can hazard a guess as to which way we think this chart is going to keep trending. And e-commerce is filtering into every aspect of our lives. Amazon obviously pioneered it in books, electronics, apparel. Platforms like Uber Eats have revolutionised the way we do things, and we've got food delivered to our house. COVID lockdowns accelerated penetration into less traditional categories. Thanks to Temple & Webster, you can get your furniture delivered to your home. But increasingly, there's an ongoing shift to high-friction, high-ticket categories such as cars. So why is there an opportunity for disruption in used car retail? Well, you probably don't need me to tell you, if you've ever bought or sold a used car, why this is one of the worst consumer retail experiences, marked by uncertainty, wasted time, and a lack of trust. Where it's scrolling through car sales, which is a great business, but many hours scrolling through listings, trying to compare price, trying to compare vehicle history, driving out to locations everywhere, test driving multiple vehicles, haggling with private sellers or used car salespeople. It's not a good process. And surveys show that used car salespeople consistently rank among the least trusted professions. But there is a better way. And our thesis is that online used car buying and selling is the way of the future. You might have heard of a stock in the US called Carvana. It's been a battleground stock, but based on recent financial and share price performance, the bulls are firmly in charge. It has already proven the model at scale. It is the fastest growing and most profitable used car dealer in the US. It has a $75 billion market cap, despite only having 1 to 2% share today. The stock I'm pitching today is called Auto One. It's the Carvana of Europe, and it offers exposure to this powerful structural growth thematic that earlier in the journey. Again, back to basics, what makes a great company? Well, we like to invest in companies with great moats, just like Buffett does. He said the most important thing for me is figuring out how big the moat is and how durable it is. And so 3 things that we often look for: a superior customer experience, something that's hard for competitors to replicate, and something that's invariant to technological and societal change. And these things, especially when combined together, can deliver high returns on capital, strong margins, and the ability to grow. A recipe for strong share price performance. So how do Carvana and Auto One tick these boxes such that we think that they have a really endurable moat? Well, they were founded on that earlier premise that used car buying is a fundamentally bad experience. Their mission is to change the way people buy cars, and that's grounded in providing the best experience, the best selection, and the best value. You can buy a car online in as little as 10 minutes. You can get it delivered to your doorstep as soon as the same day in some markets. And you have a 7-day money-back guarantee after you trialed the car to get a full refund. They offer the best selection with over 50,000 cars available on the website, and they run a vertically integrated model, which delivers significant cost savings compared to traditional dealerships, and they give this back to the consumer through price. This means that they've evolved into a trusted brand with deep customer loyalty and satisfaction. Secondly, they've disrupted the industry by addressing the cost side of the equation through vertical integration, and this has delivered significant cost advantages and network effects. Whether it's a self-service platform, the fact that they purchase their own inventory, they own reconditioning centres, they own the logistics and the fulfilment networks. It's a fantastic model, and it's very hard for competitors to replicate. And lastly, they've spent billions of dollars over more than a decade building this significant physical infrastructure across the US. It is very hard to replicate, and unlike maybe just a software stock, it's significantly more immune to AI disruption as a result. So overall, Carvana sells a product that's similar to 63,000 dealerships in North America. They earn revenue in the same way, but with a different cost and pricing structure and a differentiated customer experience. This has led to them becoming the fastest growing and most profitable automotive retailer in the US. And this is an exciting prospect in a $1 trillion market where they only currently have 1 to 2% market share. The market has recognised this and endorsed their proven profitability and outlook with a $75 billion market cap. Back in 2017, they had 8% of the total market cap of their peer group, and that's blown out to 72% today. So Auto One. This is Europe's answer to Carvana. It was founded in 2012. It's a vertically integrated ecosystem. It's founder-led. It's already the #1 automotive platform in Europe. It has over 600 million of cash on the balance sheet and no debt, and it's got rapid growth and profitability. They have 8 consecutive beat and raise quarters, and we believe it's poised to continue. Just like Carvana, they've got the same business model and moat, grounded in a superior customer experience, vertical integration delivering significant cost advantages and significant physical infrastructure. Also, they've had very strong execution since inception. This is not a show-me story requiring heroic assumptions. It just involves more of the same. Margins and profit are inflecting, and this is typically a great time to own growth companies as they're transitioning from being loss-making to profitable. They're in over 30 markets in Europe. They've currently got 2.5% market share, but they've guided the market to getting that to 10% over time. EBITDA margins currently at 2%, but again, they've guided to 5 to 9% over time. What does this mean? Revenue is going to be multiples of where it is today, and earnings growth is going to be even higher through the combination of that revenue growth and margin expansion. And to valuation, it trades at a 30% discount to Carvana on an EBITDA multiple, and even more on a revenue multiple. Carvana shows that dominant tech platform businesses are richly rewarded by investors, and it has delivered a 15 times shareholder return since it was Auto One's size. And on absolute returns as well, this chart here shows its own EBITDA multiple over time. And as you can see, it's more than 1 standard deviation below its typical EBITDA multiple at only 22 times today. So we believe it's being priced like a cyclical trader, just as profitability and platform network effects are compounding. And we believe that the combination of very strong earnings growth and more than 40% per annum over the near and medium term, combined with the potential for a multiple re-rate, has the ability to deliver very strong shareholder returns. So overall, we believe it is a mispriced long-term winner. E-commerce will continue to colonise high-friction, high-ticket categories. Vertically integrated online used car retail is a superior model and will continue to take share from offline channels. Carvana has validated this model in the US, and Auto One offers exposure to this thematic, but earlier on in the journey. This is why we own Auto One. And if you like this business model, as a bonus round, there's an Aussie version of Carvana and Auto One. It is called Karma. Disclaimer, we do own it as well, and it is slated to IPO on the ASX very soon. Thank you.